Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am the CEO and founder of Sound Financial Group. I'm joined by Corey Shepard, who is now back with us. Everybody's happier that he's here. And we know you're all here just to see Corey. I am merely, I'm not even eye candy. Ear candy? Maybe that voice? Ear candy. The podcast listeners don't know what I look like, but if you get a chance, check out the YouTube channel. Don't forget to subscribe, like the video, comment below, and you can see why my wife said I have a face made for podcasting. She didn't say YouTube. Corey, what do we have for him today?
Sorry, I never know quite when Paul's going to hand it over to me and like what I'm going to have to digest from what he just said before I say anything. I just needed a second. All right. So this is a fun article from the New York Times, which, by the way, you don't have to get from the New York Times. Paul, you weren't able to get the login working and went and found it somewhere else just with a little Googling. Like, here's the weird thing. If you can't get into an article, like all you can see is the first 2 inches because of a paywall, just take that title, put it into a web search, and you're probably going to find it somewhere else that you can get at it. Now, I don't know what that is about the media industry, but I do know the problem that it suggests is that you might think that you're getting a lot of different sources on one topic that are really just all based on the same article and the same root source. So we've talked about that before. Just a good reminder to be careful. This one has some really good data in it. So this is one we're enjoying and walking through you with because they just nail it. But this is key. We are going to talk about with the odds on their side, they still couldn't beat the market, that the stock pickers and actively managed mutual funds couldn't outperform the market. And the thing to consider is you don't see articles like this that often in the Wall Street Journal, in the New York Times, in Money Magazine, or any of them. Why? Look around at who their advertisers are. And most of their advertisers are going to be financial institutions. They're going to be companies that market actively managed mutual funds. So just be aware when you see these articles. The reason we go deep on them is you don't see them that often. And they're really great to see out there. We want to push more people to go see them. We'd love for the institutions to write more of these, but you are not the New York Times customer. You are not the Wall Street Journal's customer. The advertisers are their customers. Your eyes on their content is what they sell to their customer, which, as Corey likes to say, how do you put it? If you sit down, if you don't know what you did to earn a seat at the table, you might not be sitting on the table. You might be served on top of it, or sitting at you might be served on. Right. Yeah, you might be the serving. I think that's the case in a lot of these. So we really want to acknowledge the New York Times for a great article, all of this. And this is the point, is really encapsulated in this first little few sentences. It's awfully hard to beat the stock market consistently. In 2022, despite many advantages, most mutual funds couldn't do it. And there are important lessons in that failure for this year and beyond. So their point is, active managers, that means a manager who is actively trading stocks on the inside of the mutual fund for the sake of being able to produce outsized performance, more than what the index would have done if you'd have done the index without the stock picker, okay? Now, and the S&P 500 is not the entirety of the market, but it is what a lot of media sources are talking about when they say the market was up or the market was down. And the S&P 500 was down 19.4% last year, which is even more startling in comparison to this next piece of data, the paragraph down below. It says the average stock did better than the overall market.
Now that sounds strange. How could the average stock do better than the market? Because you would think the average stock would be the average.
The market up, right? Yeah. But it did.
But you guys may have heard that episode we did some time ago, where Corey talked about the fact that the S&P 500 may be the biggest tech fund you didn't know you owned. It's because at the time of that recording, Microsoft, Apple, Google, Amazon, and Facebook, MAGA F is how I remember it. They were 22% of the Standards & Poor's 500, meaning 5 stocks took up 22%, meaning the other 495 stocks had to split up the other 78% of the index's total investable assets.
And that's not linear either, because it's cap weighted, size weighted. So all the way down, the next biggest stock is proportionally more than the one right below it.
Exactly. And so the average stock inside of the S&P 500 did better. So that meant that the odds actually favored a stock picker last year. Plenty of companies to choose from. Many of them would have given them better performance. And my favorite line this is not Corey's favorite line. I think it's coming next. And in fact, as a group, actively managed mutual funds fared better against overall market averages than they have since 2009. Now, I want you to keep that in mind. The best that they've done since 2009 in 2022, about 11, 12 years later. And the very next line of the article is what, Corey?
That one. That's not my favorite, but I'll read it. So I love this. Actively managed funds underperformed less badly in 2022 than they have in most years, but they still underperformed. And my favorite line, right from 2001 through 21, anywhere from 55 to 87% of active managed funds that invest in the S&P 500 stocks couldn't beat that benchmark, compared with the results for 22, which were about 51% of large cap stocks funds failed to beat the market. So active managers, and this is the next part, active managers couldn't quite achieve what random chance would predict, that 50% of actively managed funds would beat the index, and worse. In other words, their performance for 22 looks slightly worse than the results of a random coin flip.
Now, for those of you that have seen the Illusions of Investing that we have on the channel here, if you haven't,
this is kind of a recap series of that.
Yeah, you definitely want to check out. In fact, Miranda, I'm going to keep an eye on the interview chat over here. If you'd tell me what, I forget what episode number that is, we can tell everybody here in a second. But one of the things that we talk about is active managers tend not to outperform the indexes that they're being compared to. And the longer you study it, the less likely. 94.8% can outperform their index over 20 years.
Right.
Think about that. So if you own an actively managed mutual fund, just think about this. You're going to hold a portfolio for 20 years. If you choose an actively managed mutual fund, you only have a 5.2% chance that you owned the actively managed mutual fund that outperformed. So if you own 20 funds in your portfolio, one, statistically, when I say probably, I mean probability, probably doesn't outperform.
Even over just 3 years, 74% of actively managed funds trailed the index. So there's this data here, 3 years, it's 74%, 5 years, it's 86, 10 years, it's 91. And Paul already quoted that over 20 years, 94.8% underperform. This is why short-term analysis is it's so misleading, because we should look up some of that data in another episode, but I would guess that over 3-month periods, like if you have some actively managed guru fund and you're looking at the long-term data, but you're like, oh, maybe this is the one, like, let's just give them another few months to see what it does. Well, 3 months, 6 months, I bet it's pretty close to 50-50, whether the active or just a long-term passive index looks better over any one of those short-term periods. Yep. But when you come out to the long-term results, it's alarming how one-sided it is against active managers. But that's not even my favorite part or our favorite part of this article. We're still getting to the main event.
When you look carefully at the results for 2022, the performance of actively managed funds is much worse than it may seem at first glance, because it really wasn't a coin flip. Meaning they had a big insight.
Yeah.
It's almost like the active managers had a trick coin this year, but they like didn't put the battery in it, or like it didn't do its thing.
So this line, right? If for the stock market, 2022 was a special year. If there was any year in which stock pickers should have been able to outperform the broad market indexes, 2022 was it. Yet most still couldn't beat the battered stock market.
Yep.
Wow. It's wild.
And now what he starts to talk about, which you don't need to get into, he's getting a little in the minutia about the fact that 2023, the landscape is different, and now the deck is stacked again against active managers. So it's like, so one thing he threw in here is if in 2022 you did an equal weighted S&P 500, meaning it wasn't weighted for the cap of stocks, you were just putting I think I'm doing this math right. 0.2% into every single stock for 500 stocks. That outperformed the standard index by 7 percentage points. That's when the mega caps didn't do the work. That implies that if you just picked stock at randomly last year, you should have done better than the overall index because the typical random stocks, pardon me, did better than the mega caps.
Yeah.
But most active managers couldn't do it.
Like a monkey with darts picking a portfolio should have been able to do better, but the active stock pickers did worse.
Yes.
Like if you're not outperforming the circus monkey, that's a problem. But see, even 1 year, like if it was just 1 year, there's plenty of years that active index that beat everything else over 20 years didn't. Is the problem with looking at just one short amount of time to set your entire strategy for the rest of your life or for the long term, because there's lots of noise in the short periods, lots of noise. And that's why we're having so much fun.
Indeed. Of course, yes. And so improving your chances. Now, I like this line a lot. It's definitely possible to beat the stock market. A small number of people will probably do it over the next 20 years. But I don't know who those outliers will be. Somebody will do it. And all the academic evidence shows us, even if they can do it, they cannot repeat it. So what do we do? Well, one of the things we need to do, because I want to leave you guys with something you can actually do about this. We want to be able to get the market's rate of return. But of course, as you're trying to get the market's rate of return, many of you you may be navigating it solo, or you may be navigating it with an advisor. Now, for those of you that want to take a look at that Illusions of Investing, Miranda just got back to me, episode 194. And we'll link that in the description of this video so you guys will have it. But the thing that we have to think about is, what is our investment strategy going to be? We're saying that the stocks can't beat the market, but then fundamentally, if all I do is purchase indexes, then all I'm going to get is market performance minus whatever frictional loss it was to get in the market, right? I'm going to be minus the money it took to have the asset manager, minus the money it took to pay the ETF fund costs. So what can we do that would be different? Well, for those of you that have seen the Illusions of Investing, or your clients of our firm, we tilt toward those areas that academically show over very, very long periods of time, small amounts of consistent outperformance. Now, we're not going to get deep into that because we don't have the time for it today, but we want to line up what that looks like with our actual portfolios. And we did that here. This is a comparison going back to April of 2022. So this is over a 20-year comparison. And what you can see on the screen here that's being compared is the S&P 500, the Vanguard Core 80/20 portfolio, the Vanguard 80/20 that's VASGX, a different 80/20 portfolio they have, our 80/20 portfolio, and our 100% equity portfolio.
So you'll notice our portfolios have our advisor fees taken out of them, and the S&P 500 doesn't, nor does the Vanguard. And we use these for a lot of different reasons. The Vanguard, we're not picking on Vanguard. We just wanted a long-term passive index in there as an example.
With no fees, no load.
With no fees, no load, nothing. Yep.
And so what you'll see over this 22-year period, if you just own the S&P 500, you had a wild ride, not to mention you had almost 10 years of no returns. You can even see it on the graph. That after, let's see, even on this graph, it's 9 years of zero returns.
Yeah.
And then it takes off and works its way up. But for the diversified portfolios that didn't have the same level of volatility, the 100% equities portfolio almost beat it. The 80/20 portfolio from dimensional funds did 298%. And then you don't know which of these two no-load index portfolios you might have ended up in with Vanguard. There's two choices you could have picked at least, and we picked two of them, and they had very different outcomes. We don't know why. Mm-hmm. But what we know is if you tilt toward those areas of the market where we get a little bit of outperformance, again, I refer you guys to episode 194, where Corey and I go through that. But there is a way to get market performance with the help of an advisor. Mm-hmm. It's just going to be a portfolio that is really unsexy and isn't going to chase market returns because it's invested in a way like institutions would invest to get the maximum return on their money. And that's what we want our clients to be able to do, is have the same level of dependability on their investments that, say, a large institution would. An understanding of volatility, so we see it for the opportunity that it is, and then appropriate structure of the rest of your financial life, that it doesn't matter what the performance is this 6 months or 2 months from now or 2 years from now, because we built enough insulation around you and your aims on your balance sheet that you're okay even as the market's volatile. But what we don't want to do is be chasing after market returns from active managers, or above market returns from active managers who as a group have not proven themselves successful in being able to do it. And I don't know how they stay in business. I'm glad they do, because it gives us a competitive advantage, Corey. But imagine if landscapers, that every landscaper you had for 20 years would have not maintained your lawn better than rain.
I heard of goats just like walking around randomly, chewing on grass. Yeah,
random goats and rain outdoing that's the market on its own, outdoing all these active managers. If your yard looked better just leaving it exposed to the elements, people wouldn't hire landscapers. It is the marketing machine of these financial institutions, the amount of money they put behind them. The asset management firm we use, Dimensional Fund Advisors, you guys can look them up. They're probably the biggest asset management firm you've never heard of. Why? I liked telling the story of Oppenheimer, Corey. That before Oppenheimer was sold to PIMCO a few years back, Oppenheimer had half the amount of assets under management as Dimensional Funds. But Oppenheimer had double the amount of employees.
Wow.
Because of their huge, huge marketing forces, telling advisors over and over again why they should teach their clients to buy their funds. That's the reason why there's so much dollars and so much overhead, and frankly, why there's a lot of fund costs that don't need to be there, because they're having to spend their efforts to try to recast how ineffective the active managers have been, to basically try to say, this time this strategy is going to work. And as you guys get a chance to watch The Illusions of Investing, we're going to tell you about how they shut down funds and don't have to report their returns anymore. How it is their trading causes extra cost on the inside that's difficult to outperform. Right. And how you can build a portfolio that will give you that level of understanding. Because if you have understanding why your portfolio is doing what it's doing, you can actually weather this stuff a lot easier. than some advisor saying, oh, our manager made a mistake and went a little too heavy in China this year. And it did okay, so what's going to happen next year? If we're not investing based upon scientific principles that I can understand as the investor, then I don't want any of our clients in it. And so that's why we want for all of you. So if you get a chance and you have a portfolio that you think maybe needs to get a look at it, or at least some extra advice, Corey, what can they do?
So you can send a message to info@sfgway.com and someone would be happy to, on our team, would be happy to have a conversation with you. In the meantime, make sure to like, subscribe, do all those things. It really helps the channel and helps get it out to people that this could really be useful for.
And with that, from all of us here at Sound Financial Group, and most especially from Corey Shepard, we hope that this has been a contribution to you being able to design and build a good life.